All right, welcome to the financial education presentation on budgeting. My name is Kristen Short. I'm a PhD student in financial planning in the College of Family and Consumer Sciences, and my assistantship is with the graduate school working on graduate financial education. And the purpose of this assistantship is just to help graduate students increase their knowledge and literacy around finances in an effort to help reduce stress. The research shows that financial stress is a big deterrent when it comes to students completing their graduate studies. So the hope is that through this education, we can help prevent some of that graduate student attrition and support you all in your journeys throughout your graduate studies. So to get started, I'd like to start by just asking, what is budgeting? So a lot of times when I give these presentations and I ask, what is budgeting? I hear things like restraining or sticking to a tight boundary line or tracking expenses or, a lot of detail-oriented restriction type of words. And so then I follow up that question with, well, when you hear the word budgeting, is it generally a positive word or a negative word? And most people would say that they have a negative association with the word budgeting. So when I hear these things and when financial planners hear these things, they like to kind of spin it to make budgeting not seem so negative. So a lot of financial planners will say, okay, well, it's not budgeting, it's creating a spending plan. And so then it's not so much about what you can't buy, but it's about what you can buy. Well, for me, I like to think about budgeting as a process of managing net worth. So what is net worth? Net worth is basically the sum of your assets minus the sum of your liabilities. So your assets are anything you own and your liabilities are anything you owe. Some examples of these would be, for example, for assets, you have liquid assets or investments. These would be things like the cash in your bank account, if you have a money market fund, and then for investments, if you have some retirement savings or some stocks or bonds. And then of course, liabilities would be things like outstanding credit card debt, outstanding debt on a home mortgage or a car loan or a student loan. So when we say net worth, we mean the total value of all of your assets minus the total value of all of your liabilities. Now, how can you increase your net worth? Well, there's two options. First, you can increase your assets or you can decrease your liabilities. So when it comes to budgeting, if you're spending more than you make each month, you're inevitably contributing to your liabilities, so you're decreasing your net worth. If you're spending less than what you're making in income, then you're inevitably saving or increasing your assets, which increases your net worth. So the way you budget on a day-to-day basis has a long-term impact on your net worth. And for me, this is helpful to think about because it helps me kind of get out of the minutia of the day-to-day detail-oriented aspect of budgeting and see the long-term impact or the long-term goal that that budgeting is pointing to. It also helps me to reduce stress a little bit. So, how many of you, when you go out to eat with family or friends and you're ordering your lunch or your dinner and you get to the drink part and you're like, well, should I get a water or should I get the Coke I've been thinking about all day? And those little decisions can cause a lot of stress, but if you really think about it, what is a $1.50 Coke gonna do to your overall net worth? Not that much, right? So if we can think about budgeting in this big kind of 30,000 foot level view, it can help eliminate some of the stress around those day-to-day decisions that don't need to be causing all of that stress. Now, of course, we know that day-to-day decisions accumulated over a long period of time into habits can have that long-term effect. But if it's just a random day, you're deciding whether or not to get that coffee or that Coke, don't worry. Think about the long-term net worth, and it can really help kind of reduce some of that stress. So budgeting in general is a process. It includes these 5 steps, and we're going to walk through each of these 5 steps. And the first one is to understand your current spending. Second, to evaluate your debt obligations. Third, to outline your savings goals. 4, to create a budget. 5, to monitor and repeat. So let's get into these steps. First, tracking spending. So we have here a plate of food that has some meat, some veggies, it looks like some potatoes or something. So how many of you could look at this plate of food and accurately predict how many grams of protein, how many grams of carbs, how many grams of fat, how many grams of sugar are present in this meal? Chances are most of you could not do that. I know I could not do that. Why could we not do that? Because maybe we've never tracked our nutrients before to know how much each food has in it. My sister, on the other hand, who's a strength training coach and knows the importance of nutrition in building muscles, has tracked her nutrients for a year, 2 years, and she could look at that plate and guesstimate how much protein, how much carbs, how much fat, how much sugar, and she could come pretty darn close. The same with budgeting. A lot of people think that they are able to just have kind of a mental tracking of their finances where they could just know how much they're spending on eating out, know how much they're spending on groceries, know how much they're spending on miscellaneous shopping. But in all reality, if you've never tracked your spending before, you really are not going to be able to have a good understanding or a good guesstimate about what your finances are looking on a monthly basis or an annual basis. So I strongly recommend that everybody goes through a period of time where you very diligently track your spending, whether that's a few months, a year, a couple years. At minimum, though, you need to track for at least 3 months. So this can be retroactive. Let's say you want to start the budgeting process as soon as possible. Go back 3 months and track your expenses for the past 3 months in order to kind of see where you're at before you go about setting up that budget. So whether retroactive or moving forward, you're going to start out tracking your expenses, and you can use 2 main methods. The first would be using iOS or Android apps. The second would be using an Excel spreadsheet. So here's just some examples of some apps out there that will help you track your expenses. The benefit of using apps is that you have them on the go with you. A lot of them will link to your bank account, so it's a little bit less work. But my hesitation personally with apps is that I don't think it really forces you to go through the process that's necessary in order to understand your spending and kind of develop that conscientiousness about where your spending is going. Because if the app is just automatically importing all of your expenses, then you really aren't getting a sense for how the numbers are adding up, how they are. You may just look at the total at the end of the month and see, okay, I spent $200 on eating out. And you may not really remember whether that $200 came from, eating out 4 times for $50, or if it came from eating out, getting a $2 coffee 100 times. So I really recommend manual entry apps if you are going to go the app route, so that you're forced to go through every single expense and really develop that consciousness of your spending. Personally, I prefer to use an Excel spreadsheet method. So with this method, you just manually enter your expenses and transactions from the month. The way that I do it is I download my online bank statements and then go line by line through the statement, entering each transaction into my expense tracking spreadsheet. Another option is that you can collect receipts, especially if you want to track, some of the cash purchases that may not show up on your bank statements. But the main point or the goal is just to make sure that you are able to get every single transaction recorded line by line. So this is just an example of a spreadsheet that you could use for budgeting. There are so many templates out there. It's totally up to you how you do it, but in case you're not familiar with Excel and you want to see an example, here's just a quick example. So in this example, you have a row for every single transaction that you make, and then a column for the different categories in your budget. So basically you would just record an item on a row and then go across to the corresponding column that that expense is for and write the amount. And then each column gives you the totals for that category for that month. Then basically you would just have a tab for each month, and then you'd have a totals tab, which shows kind of the total amount that you spent in each of those categories throughout the month, and you can compare month to month to see how those expenses have been similar or different. So when it comes to deciding what your expense categories are going to be, there's generally two major categories, which is monthly expenses and non-monthly expenses. So you can kind of think about in your head what would be some examples of monthly expenses and non-monthly expenses. Those monthly expenses are going to be things like housing, bills, groceries, debt payments, transportation, eating out costs, entertainment, personal items, medical expenses like prescriptions, savings, and other miscellaneous things. The non-monthly expenses are going to be things like maybe your insurance payments, education fees like student fees or books at the beginning of the semester, holiday expenses are typically non-monthly, life events, moving, maybe, moving for grad school was a non-monthly expense, and then of course taxes are non-monthly. So these are just some examples of some expense categories that you might have, and it's going to be different for everyone, but let me just point out a few tips that I have in terms of selecting your categories. So personally, for me, I like to think about categories that will make my tracking experience the most streamlined. So for example, groceries and household items. I like to keep those things in the same category because I buy my household items, like when I need toilet paper or Windex or paper towel, I buy those things at the grocery store when I'm getting my food for the week. So it doesn't really make sense for me to have a separate category for groceries and for household items because I'd have to go back through my receipt and go line by line to figure out, okay, which item was a grocery, which one is household, so I can separate them into my columns. No, that would take a lot of extra time. So for me, it makes sense to have groceries and household items as one expense category. Now, conversely, this list shows utilities and bills as one category, but for me, I like to separate my utilities into separate categories because I like to know, okay, let's say I spent less on utilities this month. I want to know, is that because I spent less in water or is that because I spent less on electric? And I want to be able to see those differences. So I have separate categories for those separate utilities. So it's entirely up to you, but I just suggest using the categories in a way that will best match your lifestyle and will give you the best information that you're trying to get out of your budgeting spreadsheet. Another thing I want to point out here is that I've included debt and savings as expense categories. This is super important because if you don't budget for your debt payments and your savings, then you're going to, get to the end of the month and just find out that you don't have enough to cover those things. So those are things that have to come out of your monthly income. So they should be planned for as if they are typical expenses. So let's get a little bit into debt and debt management. Now, I'm going to go over a couple terms here that may seem foundational and maybe you've learned these things before, but from my experience in presenting to graduate students, 95% of people have never had any kind of financial planning course in their academic experience. So unless you've had family teach this to you or you've just learned through personal experience, it's pretty likely that some of you maybe have never been taught how some of these things work. So we're going to go through these, and so just bear with me as we cover this because especially compound interest is one of the most foundational and important concepts that you could understand when it comes to personal finance. So what is a debt? A debt is something, typically money, that is owed or due. It's when you borrow money or something from somebody else and you owe them that amount back. You have to pay it back. The principal is the original amount of money that you borrowed, And the interest is the cost of borrowing money, which is typically expressed as a percentage. So what is compound interest? Compound interest is periodic interest or a periodic fee that's calculated on the cumulative debt of a balance. Okay, so let's look at an example to see how this works. So let's say you had a principal amount that you borrowed of $10,000. And let's say there was a monthly interest rate of 10%. So every month you get charged 10% in interest for borrowing the money. After 8 months, you would have accumulated $18,000 in debt, right? So 10% of $10,000 is $1,000. You'd get charged that $1,000 every month for 8 months, and you'd end up with $18,000. So that's simple interest. Now, with compound interest, in the first month, you'd get charged the 10%, which is $1,000, and that would get added to your balance. So after month 1, you'd be at $11,000, the same as it was with simple interest. But going into month 2, with compound interest, that 10% interest fee is being charged on everything you've accumulated thus far. So the 10% is being charged on $11,000, which means your interest charge in month 2 is $1,100. That gets added to the balance, and at the end of month 2, you now have a balance of $12,100. Going into month 3, the 10% interest charge is applied to your total cumulative balance thus far, which means your interest charge is $1,210. And it keeps going and going and going like this. So you might be looking at these numbers and be thinking, oh, compound interest probably isn't that bad. It doesn't look that different. But with compound interest, after the same 8 months of 10% interest compounded each month, your debt would now be $21,435, which is a big difference from the $18,000 with simple interest. So the point of this slide is to say that compound interest is difficult to calculate. It's not something that we can just easily do mental math to figure out how compound interest is going to impact our debts. And yet, interest applies to all types of debt, whether it's a car loan, student loan, credit cards, payday loans. All of those debts are going to have some interest rate that is going to be compounded. So the important thing to know is that when you're dealing with these debts is to use, whether it's online calculators or whatever you need to use, whatever resources are needed in order to calculate how that compound interest is going to be impacting your debt, because it's exponential and it's so much different than what our brains would calculate, because our brains are so likely to revert to a simple interest calculation. Now, in the real world, you're probably not going to have a monthly interest rate of 10%, but you would be surprised how compound interest can impact those debts. So it's a really important concept to understand, and it's important for savings too, because the power of compounding has a positive impact on your savings goals too. So when it comes to paying on interest, the biggest thing is to cut into the principal. So let's say you had a debt of $1,000 with 20% interest. After month 1, you'd get charged 20% of $1,000, so $200 in interest. And let's say each month you're paying $200 on the debt. After 4 months of paying $200, you would have paid $800 but not cut into the initial debt principal at all, because your entire payment would just be going to paying off the interest each month. And after each month, the interest would reaccumulate, you'd pay it off, it would reaccumulate, you'd pay it off, and you'd never be tackling your debt. Instead, if you could increase that payment just by $50 even, you'd be able to start cutting into that principal, and it would start going down over time. Now, whenever 20% interest is applied to your remaining balance, it's a little bit less than $200 because your principal is going down. And that's really how you need to tackle your debts when you're paying on them, is to make sure that your monthly payment is covering more than just the interest that's being charged on the debt, and is cutting into that principal as much as possible. So when it comes to managing debt, you generally have three options to paying them off. The first option is just to pay the balance off in full. The benefit of paying the balance in full is that it avoids the interest problem. So like credit cards, you use your credit card for a month, the statement balance comes out, you pay it off in full, you're never charged interest. But the problem with option one is that it's not always feasible. So, how many people here could just come up with a bunch of money to pay off their mortgage one and done? Or how many people would, walk across the stage for graduation and the next day have $30,000 to pay off their student loans? Not likely. So paying off the balance in full is not always feasible, which is why there's option two. Option two is that you can make the minimum payment on all of your debts. The benefit of making the minimum payment is that, number one, you stay in good standing. So somebody who makes the minimum payments on all of their debts could have an excellent credit score. They'd be in completely good standing with their lenders. The problem is when you only make the minimum payments on your debts, you start accumulating interest, right? So option number three is that you can make the minimum payment plus some. And this is going to help you start tackling those debts even faster. Now, the tricky thing here is when you have several debts and you're not sure which one you should start putting extra money to first. In general, there's two main strategies. The first is the snowball strategy. The second is the interest strategy. So with the snowball strategy, the idea is that you line up your debts from smallest balance to largest balance. So your smallest debt to your biggest debt. And you make minimum payments on all of your debts, and then any extra money you have, you throw towards the smallest debt. And every month you put that extra money towards the smallest debt until it's completely paid off, and then you get to go to the next one in line. Pay that one off, move up. Pay that one off, move up. All the way up until you've paid off all of your debts. Now, the advantage of the snowball strategy is that it's based in psychology, and so the whole point of it is that you tackle your smallest debt first so that you'll get a very quick psychological win when you pay off your first debt, because that payoff of the first debt is going to come faster since it's your smallest debt. The snowball strategy is a good strategy if your interest rates are more or less the same and you kind of need that psychological win in order to have the momentum to keep plowing through the rest of your debts. However, it is not the best mathematically. So we come to the interest strategy. If you want to pay off your debts overall with the least amount of money and overall in the least amount of time, then the interest strategy is the one you want to go with. The way the interest strategy works is you make minimum payments on all your debts, and then you line them up from highest interest rate to lowest interest rate, and you put any extra money you have towards whatever debt has the highest interest rate. Okay, so the reason why you want to do that is because the higher interest rate is going to give you the best return for your money. Your money is going to go the farthest by tackling the highest interest rate first. This is a hard concept for our brains to grasp. I don't know what it is, but it's something about debt that our minds like go to mush or something. So if I were to tell you, okay, you can invest in an investment that's going to return 5% on your money, or an investment that's going to return 10% of your money on your money, obviously you would invest in the investment that gives you a 10% return, right? You do that because you know you're going to get a better bang for your buck. Your money's going to grow faster. It's going to be the more worthwhile strategy. The same principle applies to debt. So if you had a 5% debt, or a debt growing at 5% and a debt growing at 10%, putting your money towards the debt that's growing at 10% to start paying it off, that's going to give you the best return for your money. So the interest strategy is mathematically the best way to pay off your debts when you're prioritizing between debts, and it's going to give you the best bang for your buck. So let's say you're in a situation where none of the three options on the prior screen will work because you're in a position where you can't even afford your minimum payments. you're really in a financially difficult time and you're not sure, when you're going to have enough to make these minimums, so you're having to prioritize between your different payments in order to determine what's the most important. The rule of thumb here is to think about what debt would hurt me the most if I didn't pay it. So there's two kind of umbrellas for types of debt: secured debt and unsecured debt. Secured debt is basically a debt that's guaranteed by collateral. What that means is that if you don't make payments on that debt, some form of property or collateral is going to be taken from you. So home mortgage, car payment, home equity loan. If you don't make payments on your mortgage, you could get your house taken away. If you don't make payments on your car, you could get your car taken away. That debt is guaranteed by the collateral of your home or your car. An unsecured debt is a debt that does not have property as collateral. So some examples are credit card, medical bills, and student loans, but you have to be careful with student loans, and I'll get into that in a second. But in general, if you were to never make payments on your credit card, what's the worst thing that could happen? Well, number one, your credit score would totally tank. Number two, you'd accumulate a ton of interest. Number three, the debt would probably be sent to collections and you'd get a lot of phone calls. But at the end of the day, it's not like the credit card company can tap into your bank account and, take the funds from you. They can't garnish your wages from your paychecks. They don't have any collateral over you that they can take if you don't pay them off. So of course, we want to make sure we're trying to make payments on these bills, but when it comes to prioritizing, when you can't afford to make minimum payments on all your debts, you have a lot less to lose with unsecured debt than with secured debt. Now, be careful with student loans. Technically, they're unsecured debt, but if you have federal loans, there are certain collection powers that exist if you don't make payments. So they can garnish your wages, they can take your tax returns. There are some powers that they have to get the money. So generally speaking, I would treat student loans more like a secured debt than an unsecured debt. All right, so let's do a little bit of practice. So here are some different debts that a person might have. And let's say that with these debts, you could only make one of the payments. You only had enough money to pay one of these minimum payments. Which one would you pay first? Okay, so the first one you'd want to pay is the mortgage. Why? Because it's a secured debt. If you don't make payments on your mortgage, you're going to lose your house. You don't want to lose your house because you need a place to live, right? You want to make sure you're covering your basic necessities. Okay, so if you could only pay for two of these minimum payments, what's the next one you should pay? Car payment, right? It's also a secured debt. If you don't pay it, they could take your car. In some circumstances, maybe you could get away with not having a car, but in most circumstances, you need your car to get to work. If you can't get to work with your car, then you can't work and make money. So for a lot of people, losing their car would be very detrimental to their finances. So making the minimum car payment to keep your car would probably be the next thing. All right, so let's say you could only make 3 of these minimum payments. What would be next? Student loan, right? So student loan, technically unsecured debt, but there's collection powers that could come into play if you didn't make payments. Of course, there are financial hardship options that you can apply for with student loans. If they're federal loans, try and get some relief, but generally speaking, you don't want to miss payments on your student loan, and in this case, you would want to prioritize that over your credit cards. And then finally, you have your 2 credit cards. So if you could only have enough money to make your minimum payment on one of those 2 credit cards, which would you go for? I would say the one with a higher interest rate, credit card 1, and then of course, credit card 2. So now let's say you're making minimum payments on all of these debts, and then you had extra money, and you were going to send that extra money to one of these debts. Which one would you send it to? All right, so thinking about our interest rate strategy, we said after making minimum payments on everything, you're going to throw any extra money you have to the debt with the highest interest rate. So that's going to be your credit card one. You're going to throw all your extra money towards credit card one until it's paid off. Then everything you were paying on credit card one, you're going to pay towards your next highest interest rate. Now, let's say that you were going to do the same thing, but with a snowball strategy. You had extra money, you're going to do it snowball strategy. In this circumstance, it would still be credit card one. So snowball strategy, remember, you make minimum payments on everything. You throw extra money toward your smallest debt. So in this case, it's the same answer. All right, so let's get into saving. What is saving? Saving is just keeping or storing up resources for future use. You can think of it like a safety net, delayed gratification, and increasing of assets, and it's really important. So a lot of people don't like saving because they think, oh, well, that's money that I don't get to spend. And what I like to say is, well, it actually is money that you get to spend. It's just your future self that's going to be the one spending it, right? So, at least for me, I like to think that money is going to be a little more important to me later in life than it is right now. I'm a grad student. I'm kind of accustomed to living low standard of living. I actually don't really mind eating a package of ramen every once in a while. So, you know, money doesn't mean as much to me now, I don't think, than what it will mean to me later. Maybe when I have kids, when I have grandkids, you know, I want to sign up my kid for soccer or something. So for me, I have no problem setting aside money for future Kristen because I would rather future Kristen have that money to be able to do the things that I want to do later in life. So just remember, saving, it's not about you taking money away from yourself. It's just that you're giving it to your future self. And that can be a good, powerful motivator when it comes to setting aside a little bit each month in order to accomplish some of those savings goals. When should you start saving? As soon as you can. I know it's hard in grad school, but every little bit counts. It's about just forming that habit. So some short-term savings that you might want to be thinking about is establishing some sort of emergency fund, which is generally considered 3 to 6 months of living expenses, though that can totally vary depending on your specific situation. Then, of course, conference travel. Conferences are really common for graduate students to be traveling to. And then, of course, long-term saving, buying a car, buying a home, funding your kids' college education, retirement. All of these things are things we should be thinking about when it comes to savings goals. But like I said, the most important thing, make it a monthly habit. A little bit can go a long way. And remember what we said about compound interest, right? Exponential growth. Compound interest also happens with savings. The earlier you start saving for retirement, the more you're going to see the impact of that exponential growth over time. So whether it's $5 a month or $20 a month, or even if you're able to put, you know, $100 a month, just start saving, make it a monthly habit, set up an automatic transfer from your checking account to your savings account and just have it draft into that account each month. And then once you graduate, increase the amount and make it that monthly habit. So, big question. We've talked about debt, we've talked about saving. Now, which is more important, paying off debt or saving? So I just want you to think to yourself, what is more important, paying off debt or saving? All right, so most of the time when I present this and I take a little poll or a raise of hands, we get about 2/3 of the audience saying pay off debt and about 1/3 of the audience saying savings. So that's pretty typical. And so I'd like to ask, which is better for your net worth, paying off debt or saving? And the answer to that is wherever you can get the better return for your money, right? Because on the first slide of this presentation, when we were talking about net worth, we said there was 2 ways you could increase your net worth. Number 1, you can increase your assets, or you can save, Or you can decrease your liabilities, which is paying off debt. So both are viable options for increasing your net worth. Really, the question is, where can you get the better return for your money? So the answer is look at the interest, okay? When it comes to deciding if your extra money should be going towards saving or whether it should be going towards paying off debt, look at the interest. Look at the type of return you can get on the money. If you're debating between sending extra money to your mortgage that's got an interest rate of 3%, or starting to save for retirement by putting money in the market where you could earn on average maybe 7 or 8%, definitely start saving. Definitely start saving. If you're looking at credit card debt that's at 25% interest versus keeping your money in a money market account earning 1% interest, pay off the debt, get rid of that credit card debt. So look at the interest. It's the most important factor when considering whether your extra funds should be going towards paying off debt or should be going towards your savings goals. All right, so we've tracked our expenses for 3 months. We've figured out debt obligations and how we're going to kind of tackle those and prioritize them, and we set some savings goals. So now what? This is the most important part of the budgeting process, I think, and is the step that almost everybody forgets to do or just doesn't do when they go about budgeting, and that is to calculate your annual cost of living. So you're going to take the tracking that you've been doing for the last few months, or the retroactive 3 months of tracking. You're going to average out how much you're spending in each category and then multiply it out by 12 to get kind of an average annual amount that you spend in each of those categories. Then, of course, you're going to take those non-monthly expenses, figure out how much you pay on an annual basis for those, and you're going to total all that up to figure out what your annual cost of living is. Okay? Then what you're going to do is you're going to compare it to income. So you're going to think about what kind of income sources you have. Maybe a stipend, maybe a scholarship, maybe you have like an online business or you do tutoring or something on a monthly basis. So you're going to figure out what all that comes out to annually. You're going to total up your annual income. And then what you're going to do is you're going to figure out your net cash flow. So you take the total amount of income minus your annual cost of living from the previous slide to figure out what is your net cash flow. So you will see in this example, the number's negative. Now, how many of us is this a reality for? Probably most of us. Why? We're in graduate school. We are investing in ourselves. So I want to encourage you that if your number here is negative, it's okay. All right? You're working on a degree that will gain you a higher earning potential. You are advancing your human capital, your social capital. You are empowering yourself for a better financial future. It's okay if your net cash flow is negative during this period of your life. What I will say is, if you are in this situation, you have a net cash flow that's negative, you want to start thinking about whether a loan might be an option. All right, so you can take out a student loan to help cover the costs of your education, your living expenses. Just know that that number, whatever it is on an annual basis, needs to cover you throughout the whole year. So remember to divide it out, budget it out so that you're spending only the amount that you should be spending each month. Another tidbit on loans is that if you apply for student loans, you get approved, you do not have to take the total amount that you're offered. So you can always accept just a portion of that amount, and you can also request that the amount becomes available to you in a specific semester. So let's say you think you'll only need funding for the summer semester. You don't need to take out the loan starting in fall and then accumulate interest all year. You can set it up so that you actually get the disbursement of the funds starting in the summer semester. So don't completely rule out loans. It could be a good option, and we'll talk about that a little more in a second. So let's say you're at that negative cash flow. You're unsure if you want to do student loans. You're going to see if you can improve that negative cash flow some other way. Well, you have 2 ways to improve a negative cash flow. Number 1 you can decrease expenses, or number 2, you can increase income. Those are the only 2 options. So let's look at a couple examples for how you could possibly decrease expenses. I like to think about this in terms of single action wins and repeated action wins. So single action wins are going to take a little bit more time and effort on the front end, but you're going to reap the benefit of them over the long term. Repeated action wins might be just split decisions, easy things that don't take a lot of time and effort necessarily, but you have to be conscious of them continually in order for them to reap the same benefits that a single action win might reap. So what are some examples of single action wins? First, avoid fees. There's no reason that you should have late fees on anything in this day and age. Set up auto pay for all of your bills and expenses. That's one less thing you have to think about when you're juggling class and research and teaching and all this other stuff. Set up auto pay. Never have a late fee again, right? Especially if you're able to cover the cost of the bill, there's no reason why you should be late. 2, overdraft fees. You can remove overdraft protection from your bank account so that you don't get charged fees for that. You can call your credit card companies if they have an annual fee on your credit card, see if it's possible to get the fee removed. Student fees. Now, this doesn't mean that everybody can just run out and stop paying their student fees, but for certain students, maybe who are part-time or who are off campus or who are in their dissertation phase, there may be options for reduced fees or optional fees for certain students in certain circumstances. So look into it and see if you can avoid fees in any of these areas. Secondly, decrease fixed costs, whether that's your car insurance, homeowners or renters insurance, the amount that you're paying to your utility providers, the amount you're paying in rent. Decrease these fixed costs that happen every single month, because if you can get a reduction in them every single month, you're going to get the benefit of that, right? If you can move somewhere that's $100 cheaper each month, huge savings throughout the year. If you can get a roommate and cut your rent in half, huge savings, right? If you can call 3 other car insurance companies to see if they have better rates, huge savings. Do defensive driving. Tell them you have good grades. You might get discounts. Just look into ways that you can decrease these fixed costs that don't require continual maintenance, and you'll continue to reap the benefits if you can get that cost decreased. Thirdly, cancel unused or lightly used memberships. So gym memberships, especially if you're already paying for Ramsey. Streaming services, maybe you just pick one rather than having 3 or 4. Cable, we're grad students. We don't have time for cable. Maybe you just don't get it. If there's a certain show or sporting event that's really important to you, find some friends who also like that show or sporting event and watch it together at their place. Have them get cable. But, especially if you're using it lightly, which you probably are if you're in grad school, cancel it. It's a big expense that can be taken out. Food delivery services like HelloFresh, Blue Apron, etc. Unless you're going for the experience value, they're not cheaper than grocery shopping. Now, some of those repeated action wins. Be strategic about your food. Bring coffee with you in the morning instead of buying it each day. Pack your lunch. Take advantage of leftovers from the night before. If you drink at home. That is a huge expense. And if you are going to go out, go out during a happy hour time. Avoid impulse purchases, whether it's online shopping, that afternoon coffee pick-me-up, buying things for a single event utility, or sales. If you weren't going to buy it in the first place, then it's not a good sale, right? Buy one, get one free is not worthwhile if you weren't going to buy one in the first place. So think about these things. And especially for online shopping, I know a big temptation or problem can be if your credit card is linked to your online account. So whether it's Amazon or some other store you like to shop in, if you have a hard time impulse purchasing on online stores, I strongly recommend that you unlink your credit card from those sites and force yourself every time you're going to buy something online to go get out your credit card and manually type it in, because that one barrier can be enough of a deterrent to keep you from having those impulse purchases. All right, so you've decreased your expenses as much as possible. Another option is increasing your income. Now, a lot of the things on this slide you're already going to be familiar with: university resources, outside resources like fellowships and grants, loans, whether that's a family loan, government loan, or a private loan. You're probably pretty familiar with these options. I do want to just touch on side income. So if you are having a hard time making ends meet, a lot of graduate students think about the possibility of getting a part-time job. I'm not going to say that you definitely should not do that, but I would be very careful with this. And the reason I say that is if getting a part-time job in order to cover expenses, or particularly if you're going to get a part-time job in order to avoid taking out student loans or something, if getting that part-time job is going to either delay your program significantly, the time in your program significantly, or prevent you from getting meaningful experience in your field, whether that's an internship experience or some other hands-on experiential learning, or if by working that part-time job you're not going to have enough time to publish research, and let's say you want to go into academia and research is really important, any one of those things. If getting a part-time job is going to significantly detract from your ability to build a strong CV going onto the job market after your grad program, or if it delays your grad program, then I would seriously consider taking out student loans instead of that part-time job. Because if you're in grad school, especially for a career change or a big step up in career, you want to make that time as useful as possible, make your CV as strong as possible, and make the degree worth it. Make it worth a pay raise after you get the degree. And if you need to take out a little bit of student loans to do that, it could be worth it. It really could be worth it. So before jumping to a part-time job, just consider what your schedule looks like. Is there something else that's going to pay off in the long run by dedicating your time to it? And if so, consider whether student loans might be a better option. All that to say, remember to fill out your FAFSA. A lot of people may think, oh, I'm not planning to take out student loans, I don't need to fill out my FAFSA, but the FAFSA is used for other things like scholarships. So if you're going to apply for any need-based scholarships, they're going to look at your FAFSA. And you never know if something might come up and you might need to take out those student loans that you didn't think you'd need. So just make it a habit every single year, fill out your FAFSA. It opens in October. So as soon as it hits October, just go ahead and fill it out and you'll have your bases covered. So now, after all of that, think about everything we've covered. It's a lot of legwork. Just now, you get to start thinking about that budget. So how many of you, when you have thought about creating a budget, you just sat down and you wrote out, okay, I'm going to spend this amount in groceries, this amount in eating out, this amount in water, this in electricity, this in shopping, and you made these rules for yourself, and then 2 weeks later, you realized that you couldn't stick to any of them? Well, that's because you didn't do the background research to find out what's actually realistic for your lifestyle, for your current spending. So everything that we've done prior to this slide, tracking expenses, figuring out your debt obligations, setting your savings goals, comparing your annual income to your annual expenses, all of that puts you in the position to now establish your actual budget, those actual boundary lines that you're going to set up for yourself in each of those categories that you're going to try and stick to. And that's going to set you up for much better success, having that, that knowledge from those exercises to set yourself up with boundaries that are going to be realistic and that you can stick to. So when it comes to setting up that budget, again, you can use an app, you can use an Excel spreadsheet, you can use the envelope method, which is, you take out cash for the limit in each of your categories and then spend that cash for that category. When the cash is gone, it's gone. You can't spend any more in that category. So these are all options, but if you choose the spreadsheet option, it's a very similar setup to the tracking expenses, except you have that extra line in blue there at the bottom, which is the budgeted amount. And your expenses throughout the month get subtracted from that budgeted amount, and you can kind of keep track of your remaining balance throughout the month. Right, so notice that the savings amount, the loan amount are both included, and also your non-monthly expenses are included, right? So even though it says that you have $200 to spend in education this month, you have to remember that that $200 is actually just $200 that you're supposed to be saving or setting aside so that when August hits or when January hits and those student fees come out, you're going to have the money accumulated in your savings account or your checking account to pay off those student fees. So remember, those non-monthly expenses, you still have to set that money aside each month so that you can accumulate it by the time the non-monthly expense occurs. And then of course, you again want to have that totals sheet that shows you how you're doing across the different months. So I want to close with this, which is once you've set up your budget, you want to continue inputting your expenses into that spreadsheet or that app, see how you're doing. You want to monitor how it's going from month to month. Remember, it's okay. Each month is going to look a little bit different. You might not be exact each month, but just pay attention to how you're doing throughout the month, how you should be recalibrating. Remember that some of those monthly budgets are broken down from annual amounts. So you got to be saving that portion each month so that when the annual expense comes, you have the money ready. And then finally, just know what your limit means. So I like to think about guardrails. In this picture, you have a very clear guardrail that's separating the road from the cliff, right? And we know that the purpose of that guardrail is to keep cars from falling off the cliff, right? It's a protective measure. But we also see that in this picture, there's two additional guardrails or boundaries. We have the rumble strip and we have the white line. Your budget could either represent the white line, the rumble strip, or the guardrail. But you have to know what your budget means for you. What I mean is this. For me, I like to have my budget set fairly conservatively at the white line so that I know if I go over $10 this month or under $10 this month, it's no big deal. If I go over 1 month, I recalibrate, I get back in the lane, maybe I hit the rumble strip a little bit, but everything's okay because those lines, those limits that I've set for myself, they're conservative. They have a little bit of wiggle room. There's a little bit of a bumper there in case I go over 1 month. But if your budget line is the absolute maximum you are able to spend month to month, if all of your categories, the budgeted amount on all of your categories equals exactly the income that you make each month, your budget line's at that guardrail. And if you go over any of those limits, it could hurt, right? You could be increasing your liabilities, going into debt. So know what your budget means for you. And if you have a hard time staying within the limits, set your limits a little bit more conservatively and try to stick to those. And if you go a little bit over on 1 month to the next, it's okay. You'll still be okay with what your income is. So I like to think of that analogy, and I hope that's helpful to think about. And it's okay that it's different for each person, right? So just keep monitoring and then adjust as you need to moving forward. All right, so that's the end of the budgeting presentation. If you have any questions about the financial education program, you're welcome to reach out to me at that email listed there. And thank you so much.